Good morning, everyone. All right, I see growth is got good participation, so they all want to hear about growth. Siva Selvan, I spent about 30 years in the hospitality, Starwood, Accor, and then last 15 years I worked for Four Seasons in price optimization. Now I work for Long & Foster, which is an affiliate of Berkshire Hathaway. They're obviously Berkshire, and we are the East Coast entity, and we also a member of the Forbes Global Properties. I specialize on family office investments, luxury, affluent owners who are now trying to invest into hotels. So I represent more owner rep side. I'll let the group introduce themselves. Go ahead, Jay.
Okay, thank you. I'm Jay Newman, one of the 5 partners in the Athens Group, and before I tell you a little about Athens Group, the 5 of us have been together since the year 2000, which in this business, and we're a luxury hotel development company, I find that incredibly remarkable, and I think it's a tribute to just what we really excel at, and that is really relationships. We really view this business as a relationship business, and development, especially luxury development, is I think one of the most complex development product types that you can do, but it's incredibly rewarding. And I am proud to say, this will be a quick commercial. So we've just opened up our first lifestyle luxury hotel, which is the Asher Adams in Salt Lake City. And it's actually an adaptive reuse of the Union Pacific train station downtown. And we actually have also a Live Nation concert hall, 225 rooms. So if you come to Salt Lake City, hopefully you'll stop by and see it. I think you'll really be excited about what we did. We are going to open in about a month or two a Ritz Reserve in Papagayo, Costa Rica. And that's 106 rooms, 37 luxury branded residences, and 3 glamping tents. We were going to do some tree houses. We haven't figured out the tree house and how it works for luxury. We're going to get there eventually. But we did our toe in the water with the tents, so that'll be pretty good. And if you've gone on safaris, things like that, you've probably experienced the tent camping. And then actually, we're connected, as you were saying, with just what you're doing now, because we have a project in Naples, Florida, and that's a Four Seasons slated to open next Labor Day, 216 rooms. And the reason Siva and we are involved is we have 141 residences, 58 on the beach. We've got 1,000 linear feet of white sand beach. And so we have 58 residences there, and then we've got, what is it? I can't even do the math anymore. Like 78 plus on the Gulf side. And so for a total of 141 condos. So I'll turn it over to you now.
Thanks, Jay. I have a son at University of Utah, so we're excited to spend a lot of time at your hotel in Salt Lake City. I'm Sarah Eustace, founder and CEO of Main Street Hospitality. We are based in Massachusetts. We specialize in luxury and boutique destination properties that are all high character, some of them historic. This is a family business of which I'm the 3rd generation. And we are, we like difficult projects. But I spent, grew up in my family's business, but also spent 20 years in big retail outfits like Ralph Lauren and Gap Inc. and Limited Brands, and then brought that back to our family business a little over 10 years ago. I was an art major in college, so I don't really know what I'm doing on this panel, but I'll try to keep up with these finance real estate guys. And it's a privilege to be here and see what we can share. We're growing. We have 8 properties currently in the family, opening in Boston, and another one in Newport, Rhode Island, where we have another property. So growing slowly and selectively and working with great partners.
Great. I'm Mike Metcalf. I'm president of HQ Hotels and Residences by SBE. You may be familiar with SBE from Sam Nazarian, who was the creator of SLS and then eventually bought Morgan's Group, which included Delano, Mondrian, and numerous other brands. And Sam sold that company to Accor in 2021, spent 2 years really coming up with a new business plan and subsequently launched HQ Hotels. And then in September, we actually launched the Estate, which is ultra luxury brand. And to the extent of the partnerships, we definitely are focused on that. SBE, we have one partner who's Mark Anthony. We're very much focused on Latinos, Gen Z, and Millennials. And then in the Estate, which is the wellness brand, really it's a partnership with Tony Robbins, who is the king of wellness now, and he's been very heavily involved and engaged. So we're very excited about it. Prior to joining SAM, I actually was chief operating officer of a very large third-party management company that focused on upper upscale and luxury hotels. So very excited to be here, and because this is my hometown, this is where I live, and so it's always nice to stay home for a few days and get to meet people that are coming to our city. And we appreciate your business because it keeps us economically sound with all these people here. So welcome.
You also said we're going to do the post-conference breakfast at your house tomorrow, right?
Thank you.
Yep.
So first I want to talk about the trends in luxury, especially the emerging markets. When we represent any owners, LPs, GPs, private equity, they all asking the same questions. I want to put this to the panel. Where is the emerging market? The whole operative word of I barrier comes up. So 2019, post-COVID, our office phones will ring. Always people look for Sunbelt destinations, looking for property disposition, conversions, whatnot. Today, industry is, has stabilized, hotels have stabilized, business has stabilized. So let me start with Mike. If I have to explain to an investor, hey, these are markets we should really diversify, look for projects.
Well, if you want to invest, you just tell me and I'll find a place for you. Really, I would say, and we've heard a lot about it actually in the last day and a half already, it's not so much about emerging markets as it is emerging experiences. And one of the things the brands have done very well, and Jay mentioned a couple of locations, is they're literally out, and the developers literally out scouting places where they can actually create the market. So when you look at places like in Vietnam and Thailand and Costa Rica, places that you wouldn't normally look at as being high demand locations, typically these locations don't have a lot of airlift. I'm looking at a deal in Greece right now. The only way to get to the island is by helicopter or boat. But it'll have hotel, residences, and wellness all combined in one location. And we expect it to be very, very successful because it's going to be a place where the traveler of today, and more importantly, the traveler for the next 10 or 20 years, will want to go and experience that location, but also the things that you create there. I think the real trick is to be involved in that community and make sure that the amenities that they have to offer are a big part of the experiences. That's what it's not just about zip lining through the jungles. It's also about the food, the culture of the people, the markets that they provide, and I think these are the types of places that developers and the brands are looking for. The other urban locations will always continue to be popular. I know there's some Scottsdale right now has been really heavy in the United States. New York has always been popular and will continue to be. China is a huge luxury market right now for development. These are all big cities, and with those, most of those are going to have a residential component that go with it, and which makes the overall project more attractive to capital. So I really do think it's about finding places where there are unique experiences, unique cultures that people can get ingrained with that community for however many days they're there, or you're going to be in a heavy-duty urban environment where there's going to be a pretty significant residential component with it.
So on your independent space, like I know you're building your little asset empire. So is there anything you want to add to where these emerging markets you're looking for, especially where your properties are concentrated?
Yeah. No, I like what you started with, Mike, because I think it's almost like luxury can happen. We are going to be sick of that word by the end of this conference, by the way. Can happen anywhere if the conditions are created in the right way, right? what's interesting to us, and this not to be self-serving, but we still see an enormous amount of opportunity in the Northeast, sort of maybe Mid-Atlantic and North, just because that's our stomping ground. In markets that are adjacent to large, to bigger cities, and maybe in that circumference. We are right now, I would say, in year 2 of stabilization of a beautiful luxury property in the Hamptons, but it's Hampton Bays. It's closer to New York City. So for those who aren't familiar with the region, it is the less sexy Hamptons, if you will, but it's closer to New York, and it has this amazing story to tell, right? So with some of my partners who are in the room today, it's harder. The ramp up, the underwriting is harder to predict. The ramp up is tougher. But we're using all those tactics that you just endorsed in order to make this a destination and weaving in what I think, you said it, but maybe didn't use this word, which is culture. You're talking about the fact there's a Live Nation thing happening right next to your new hotel. So in looking at these places, and for us, even Hudson Valley or the wilds of Vermont, where a lot of these luxury properties are popping up, looking at where and how to sort of put your finger on where there might be unmet demand, even in places outside of Boston and suburban locations where there are a lot of high net worth people, but not the right, that resource. So we're looking at interesting markets like that, and it takes a little bit more to, convince our capital partners and do the underwriting with authority, and it takes a little bit of belief and creating a story in there, if that makes sense.
Let me just add to that. We approach this in a very organic way. A lot of what both of you said, but we've also found another good approach is we follow Goldman Sachs. So Goldman Sachs has gone to Salt Lake City, and the amount of jobs, I think the jobs that Goldman Sachs is now exporting, and they're doing it in Dallas also. We have a project in Dallas. And having that kind of validation of the market, the job growth it creates, that's just one way to do it. Another way to look at it is like Costa Rica, where we're building. We've got another project in Costa Rica that we're working on. And I don't know if you're familiar with Papagayo. If you get a chance, it's just terrific. But there's other areas that are the next Papagayo. And you're getting this critical mass like you have like in Cabo. And the other thing you look at, sometimes when you look at these markets, the sales price per square foot for the residential branded product in Cabo, Costa Rica, this is Costa Rica, not Cabo, is over $3,000 a square foot. And that's Americans coming down because going back to the whole experiential thing of what you can do there. And that's another kind of like data point you look at. It's like you look at that residential market, you say, look at the money that's coming into this place, and these people want luxury. But they want a certain kind of luxury, whether it's the whole wellness side of things, but you're right, it's that experiential. So there's different ways to arrive at this. And then you also look at markets where you say, they don't have any great product. The question is, can you find the right site for you to create that great product? That's the other thing. Sometimes you're site constrained. And the old adage of location, 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 when you're doing luxury, you want what we call beachhead sites.
Yeah. I think in your point around Salt Lake City too, those academic destinations and cultural destinations are really interesting places to study the hospitality market and see if there's enough and see if there's the right product there, which may not be.
Thank you. So next I want to change the subject into alternative accommodation. I think it's a great example of what Omi has done at Kenyan Equity. And if anybody know, they have the Amangiri. And if you look at the portfolio, they went and built a select service hotel. And if you listen to Omi, everybody says that was a bad idea. But I'm going to ask this group again, because I have investors now saying, do I get better cap rate if I build a multifamily? Because lenders are easy to underwrite. Do I get better rate if I do a BTR, build to rent? All the Gen X, they want to not rent a condo, they want a townhouse to rent. Because these are Do I get better cap rate if I build the adults daycare? I don't know whether they heard about. These are assets coming out, trying to get better creative cap rates. So question to the leaders here. Do you see alternate accommodations such as all the assets classes I said would be traditionally, the luxury hotels are going to get into the space? How do you differentiate luxury operators from these assets where it'll make financial sense for underwriting and so forth? I'll start with Jay.
Okay, well, as a developer, and as I said at the outset, this really is a very difficult but very rewarding asset class. But there's a lot of headwinds that you have. And one of the biggest headwinds you got is what it costs on a cost per key basis. It used to be if you spent $1 million a key, you would be laughed out of the bankers' offices. Now we've got projects that are doing $2 million a key, $3 million a key. We try to stay below 2, but we're also trying to deliver the best product. So how do you make it financeable? And what's really challenging in this part of the world is when you get your construction loan, your equity goes in first. So, and your construction debt is 50% to 65% if you're not doing any of the hot money like mezzanine financing. And when you say, okay, let's just say we have a 250 room luxury hotel, on the larger side, and it's going to cost me it's going to cost me $1.5 million a room. That's $375 million. Let's just say you're doing 40% equity. Right there, you've got $150 million. And how does that dog hunt? And the way you can make it hunt, and I can't speak to the luxury rental market or the extended. What I speak to is the branded residential. And sometimes you say, gee, I don't want a brand. And the lenders love a brand because a brand brings you a whole distribution network. It brings you customers. It also brings you anywhere from a 40-year to a 70-year contract. And it is tough to break that contract. Something had to gone radically wrong. So you'd say, all things being equal, why do I need a brand? Well, your lender wants it. Sometimes your investors want it. And then when you're selling real estate, people will pay a premium, when I say selling real estate, to have condos that are serviced by the hotel, either next to it, part of the hotel, with that brand. It's like the Good Housekeeping Award, because we are brand conscious people. And what that enables you to do is give your equity comfort, and it gives your lender comfort, because the premium that I think anyone would say is probably a minimum 25% premium that you get for this luxury branded residential attached to the hotel. And in our situation, we average 75% to 100%. So we're doubling the sales price in the marketplace for that residential. And in certain markets, like what we have right now at the Four Seasons in Florida, we're taking 50% deposits. So when you're looking at over $1 billion worth of real estate, closer to keep going up, and you can get half of that money in a deposit that you under Florida law can utilize, that becomes that equity that you have to put in first. So this branded residential makes these projects sing. And then you get, I hate to use the phrase, the synergism. All those people living in your residences, they have friends, they come, they use the hotel facilities, but they're also getting the benefit of hotel services that they are paying for. So it is the perfect marriage to have luxury residential that's branded with a luxury hotel, especially on the development side.
Sarah?
Yeah, I mean, I think you know, structurally in terms of these deals, you guys have more experience than I do. But first of all, I think synergy is a great word, Jay.
It's just used a lot.
What we're looking for.
Is there an iconic in here?
Yeah, and we're experiencing that right now as we integrate a whole series of residences at Canoe Place that were previously managed by Inspirato, and we're bringing them in under our management, integrating with our food and beverage partner. And I do think not only can we still create the conditions for a luxurious experience, I don't think that it dilutes that at all. It's like we're the clubhouse, right, in the hotel, and everybody gets to be part of it. They come in, they get a shot of energy, but they have a different experience and a different kind of way of using their space. I'm heading to Sea Island in a couple of weeks with my family, a place that I love that has built that model over time super successfully. And I think financially, risk, it's a risk management play that probably makes a lot of sense.
Yeah. I think, when you go back to talking about alternative accommodations, and we heard a little bit about it in this last session, and you're seeing it like the Orient Express is being revitalized. And so, it first started with what Homie was talking about yesterday. I think glamping became pretty popular several years ago. When I heard him say it costs $1 million a tent, I'm thinking about, having grown up in a place where you went camping every summer, we wouldn't pay more than $50 for a tent, you know what I mean? But at $1 million a room, and what Jay's pointing out is like a hotel room is going to cost you $2 to $3 million, and if somebody's willing to pay the same amount of money for a unit that's only $1 million, you're way ahead right there. And I think, but all of those, whether it's the yachts, the tents, or the trains, and I'm sure, barges, they're all different types of luxury experiences now, and it will continue to grow, no doubt. I'm sure that they will figure out how to get a balloon to lift you up and stay there. People will want it, and I think it's a matter of really having a conviction about that particular type of experience you're going to provide, and being able to sell it to both equity and debt, because ultimately, that's going to be the thing that's going to get these deals done. But I do think there are already enough examples of it, how it does work. Hungary is, sort of the poster child for glamping. And you can take people and show it, and two of them, and they can experience it. And I think, you get the right lender on board and the right equity partners on board, and you'll have a programmatic approach to future projects, not just in that glamping necessarily, but that's when, you go to the other alternative type stuff. The extended stay piece of it, I know you mentioned that too, is I think that one's a little more, that goes almost back to the residential at that point, where people are buying these units and then they're renting them for, whether it's short-term rental or long-term rental, because of the amenities and the brand name that goes with it. So if it's a Ritz residence or a Four Seasons, something like that, they put those things into pools and people stay there because of it. They know they're going to get a home and not just a hotel room, so.
It's interesting.
Yeah. Go ahead.
You have an add-on, Jay?
I was just going to.
Well, just it made me think of a colleague.
No, you go. I set it up, but I just want to talk about glamping for a moment. But go
Well,
ahead.
mine's on glamping too.
Yeah.
It's kind of adjacent,
Do
but a colleague who founded Auto Camp, not in the luxury space specifically, but these Airstreams kind of out in.
Yeah.
And, amazing ramp up, hit a tough plateau, and just partnered with Hilton reservation system to sell Auto Camp sites. So there's something in this alternate space that even the big brands are tapping into.
That's a perfect lead-in. So I'm familiar with Auto Camp.
Yeah.
I've stayed at Auto Camp. They're incredible, but I'm not a tall guy, and I'm cramped in an Airstream trailer. And so I think a lot of this is novelty value.
Yeah.
And when you go to Africa, you want to be in a tent. But there are trade-offs in those tents. You're not going to get the same insulation that you might otherwise get. It can get pretty cold even if they're insulated as much as they can be. And there's a lot of charm. The question is, how am I going to keep going to the tent? Or am I going to come back to more brick and mortar? Because that brick and mortar has a lot of experiences, and that's what I'm really into. So I think to me, it is a bit of a novelty, but the market's deep because most people have not experienced it. And so we'll be interested to see what happens with our Costa Rica project, because we got 3 tents, but we also got 106 regular rooms.
You'll probably be building more tents.
Yeah. The tree house is the one that's got me intrigued.
Jay, we got to see
figure
these
that.
tree houses come
We will do that.
There's one outside of Portland, I think. There used to be, I can't remember, at a resort that they had tree houses.
I think that is ultimately cool.
I think next we want to pivot into these. I think we heard this throughout the conference, the generational wealth transforming into the younger generation. I can tell you, we do about north of 20 billion in total transactions within the residential primary sector as well. Single family, the first time buyer also, we are seeing the same thing. The parents and the grandparents are giving money for down payment to buy. So we're seeing that money is already happening on that space. So the question for the leaders again, as you are developing these rooms and units and luxury space, how you are factoring these next generations? Because I remember when I was working for Four Seasons, there was a brand brought some of these millennials into a workshop lab in Bethesda, one of the big brands, and they asked him to do a UAT to find out, you check into this room, tell me what you like about and what you don't like about. And they learn from that to design the next generation, because you see today a lot of hotels don't have big working desk. That all came from those UATs. So Jay, I want to start with you.
Okay, yeah, look, I have a couple millennials, and I'm going to give you guys a quick little factoid. So we have this project I mentioned in Naples, Florida, and it was an existing hotel on the beach with a golf course that Jack Nicklaus had done the second round on, and we're working at Fazio right now. But we were wondering, in light of this, what do millennials want? And they want to be environmentally sustainable. They want farm to table food. They don't want formality, but yet they want to be recognized. They don't want to wait in line. For all of us who've waited in line recently, they're very impatient. And the question is, how does that fold into something like a golf course? And we went out to 3 of the top golf course designers in the world, and Fazio was the one we ended up working with, and they came up with concepts. Every one of them came up with the fact that most people don't have 6 hours, especially this generation, to spend on a golf course. So you start coming up with other things that they can do with their families. So you do what they call like the Himalayan putting courses, extreme putting course where you can sit there with a cigar, a bourbon, your kids, you're barefoot, getting into that experiential with what has been a very traditional sport, having a whole short game area, having teaching areas, and the family part of it's really coming into play. But that's just one example where, is there really life for an 18-hole golf course? You can we got guys doing 9 holes and 12 holes, and saying if they want to play 18, the guy who just played 12, he just plays another 6, so you have another set of tee boxes. It was really interesting because a golf course is 106 acres. That's a lot of real estate, and if we can wring out other experiences that is unique that other places don't have. But ultimately, you got to get rid of your plastic bottles. You got to have refillable bottles. I mean, across the board, all the brands are doing this, and I'll let these people speak. One last thing is, what's really surprising me is we're doing this Four Seasons. I was talking to the Four Seasons guys, and the millennials are treating hotels like Starbucks. So they are in the hotel lounges, they're in the seating areas, and they're on their computers, they got their earbuds in, and they're exporting it from their room into the public areas because that's how they do things. So now you're looking at greater public areas just so they can sit there and hang out on their computer. So more ideas from this part of the world over here.
No, Jay, those are really interesting points, and it's making me think about something that's been on my mind lately, as it relates to sort of the sustainability of our business and sort of our industry. And it's listen, trying to be all things to all people is never usually a winning strategy, right? So you say, okay, who's my target customer? How am I going after them? Is it Gen Z, Y, X, whatever? I don't even know which one I am. I lose track. But what I've been interested in is this idea of sort of intergenerational life inside the hotel, right? And at our hotels, probably at yours too, Bruce, historic hotels, the Red Lion Inn in Stockbridge, Massachusetts, where I don't know that anybody's ever been there, in this room. However, we see, and what we're trying to do in this 250-year-old building that my family's owned for 55 years, is create the conditions for 4 generations to have a great time in the same hotel.
Yeah.
Right? And what does that mean to technology? It's got to be right, I get it. But we have a speakeasy downstairs where the bourbon selection's amazing and a lot of the hipsters are hanging out. Their grandparents are upstairs having a great meal. We're sitting on the front porch. The children are doing something else. And to me, that's when we win. It happens at Canoe Place too. We're not obsessed with youth necessarily, although we want to capture them and keep them with us so they grow with us, right? But I think when I get excited about looking at our demographics, who's spending, what's going on. It's this idea of intergenerational life, which I also think is kind of healthy, right? If we get these families and people communicating with each other of different
Absolutely.
ages and backgrounds, that's also a good outcome. So it doesn't answer your question super specifically, but it says that I think in a great hotel, you can foster that in a way. Older people have maybe more time and money. Younger people need a place to do leisure, whatever they're doing. And you can, especially in luxury properties that have a lot of dimensions, I think that's an interesting thing to strive for.
I know, Mike, your brand is really honing on this,
Laser
right? So
focused
I'm sure
on it.
you just
Yeah,
help
like I
us.
was talking about, you're putting a luxury property in a location where people can come and experience the area. But then when they get done for the day, they're going to come back to the hotel, and that's when you have the opportunity to continue that experience for them. And they don't just go to bed. They're not going to have room service, most likely. And so, to Jay's point too, is like the lobby, the activations that you have going on in the resort or the hotel are incredibly important to them. And you need to create places where they can have their Instagram moments, where they want to share with their families or their followers the experiences that they're having. And honestly, this is free PR. So it just helps further your ability to drive more business. And really, from our standpoint, we have restaurant and bar concepts, both day life and nightlife, in addition to speakeasy brand, every other kind of cuisine you can think of. And those brands will be a big part of it, because when they come to the hotel, they'll recognize it. They'll actually want to stay there because of the food and beverage that we have, even though they will most likely be out, experiencing the local area all day long. They know when they come back, they're going to have something to do. We're going to entertain them basically the entire trip. So I really think, Millennials and Gen Z over the next 5 or 6 years are going to end up representing almost half of the retail spend in the world, not just the US, everywhere. And, capturing their money is going to be a key to success. And the way you do that, to me, it's like you look at every square foot of your property and figure out how do you get something that they want to spend money on, whether it's a cup of coffee, or a cheeseburger or a $100 steak. You need to have the ability for them to spend money, because they will. They won't if you don't give them the opportunity, and it's got to be something that is very overt, not covert, like it's right there that they want to do it. They can't wait. They don't care what it costs. And so I think, focusing on creating those experiences when they're inside of the hotel, out of their rooms, it's incredibly important, the overall profitability. There's no question that technology is a huge component for them. We were joking about it yesterday. It's like, the one click. I don't know if you've ever tried to sign up for LinkedIn Premium. I got to click 8 and said, close the app. I'm not doing this. I couldn't believe it. I was just like, it's like, I got so annoyed by the ad asking me to join. I was on a call and I decided to do it, and I literally got to the 8th question. I'm like, I'm not trying to buy a house. I just want to join your program for $10 a month. And I just said, forget it. I'm not doing it. So.
Jesse, here's a question. Maybe this is just a follow-on question. Like, in getting people to triggering desire and more spending during the stay, are you communicating with people while they're there? And does that feel, are we doing it in a luxury way? Does that feel luxury, right? We're all doing it in different ways, but hey, we're so glad you're here. Come down for XYZ that's going on.
Yeah.
Or, oh, can we book you a massage in the middle of the, does that feel on brand in terms of the luxury experience that we're talking about?
To me, like, the texting is important. A lot of people have tried to do the app, and like if you're Marriott with Bonvoy, that's fine. You've got 120 million members. The same thing with all the other major brands. So you're going to have the app. But if you're going into a one-off location, the idea of adding another app to your phone is just not exciting. But I do think that it's like you can't find them anyway, and they don't work most of the time. But I think the idea of communicating with them on a service standpoint, and not, so like you check in, and I can tell you, living here, I've done a lot of staycations here. You check into a hotel, and you're very likely to get a text a few minutes later saying, I'm your butler, I'm your concierge. Anything you need, please, let me know. And by the way, the cocktail of the at 5 o'clock is, done by our mixologist. Please make sure you stop by. And that's the kind of stuff that really gets them excited, and they'll come and they'll spend $25 for that cocktail.
So let me just add to that, and I really want to comment on what you were saying about intergenerational, because we are all over that. And we're actually, as we design these luxury condos, and we were having this huge internal analysis with our partner, which is BDT MST in Naples. And the question is, gee, who's your audience? Who's your buyer? How big should these be? And we went with average 5,000 square foot residences. We have very few residences that are less than 3,000. The smallest are like 2,300. We went larger because of what we view as intergenerational living. And just down the street in our Salt Lake, our Park City project, the Montage Deer Valley that we did, and this goes back to what you were saying. We created in the basement something we call dailies. It's got a pizza oven, it's got a bar, it's got a four-lane bowling alley, and it's got like shuffleboard. But like most shuffleboard, and not the kind where you're using your legs and everything. It's just the finished wood shuffleboards that you see in most sports bars. But now you're doing it with your kids, and maybe you're doing it with your grandkids, and everyone is in on it. You're grabbing pizzas and burgers. You're getting brews, local brews, and all that. And we don't even like sell it. It's word of mouth, and like meet me at Dailies, and that's where everyone congregates for après ski, or when it's off season and you've been hiking and everything. It's just the spot. And now we're in our Naples project. We're doing another 4-lane bowling alley next to our restaurant on the golf course. And some of these things are just, I think, they just transcend generations. But the ability to people get together, gather, and just have a good time, and then of course turns into an Instagram moment.
Yeah. And grandparents will spend anything.
Oh yeah.
So we have one more segment, then we'll open up for question. I think this is probably everyone's interest to the Fed's impact on the build and development and conversion. So I pulled up some data points from JLL. Year-to-date September 2024, the global hotel transactions and conversion volume anywhere $41 billion. And if I go back and look at 4 years after the last recession, we are about $39 million. So we are right at par 4 years after recession, today 4 years after COVID. Looking at the developers, if I have to explain to an investor, hey, how do I get better return on investment considering the build cost, development cost, acquisition cost, labor cost, and whatnot? What are the things that a hotel luxury brand can make the owners or investors at ease? How are you able to go through this notion of Fed interest rate, and obviously there are some light end of the tunnel?
Well, look, to me, the factors, as I said earlier, you want to have great real estate if you're at the top of the market. There's no doubt that a declining interest rate environment is your best friend, because as I was talking about your debt, which could be 50 to 65%, and like I said, ignoring all the other hot money products, that debt is tied to something called the SOFR curve. And that SOFR curve is a variable curve. And so when interest rates go up, your SOFR curve goes up, and that means your interest costs go up. And it takes basically 3 years to build one of these things. So when you started with that construction loan, you got 3 years where you're not getting any income. You may have an interest reserve, you may have bought an interest rate cap, but besides the fact that you have got 3 years of construction, you've got another 3 years of stabilization.
Yep.
So it's 6 years, and that's where these risk profiles come in. And so if interest rates are dropping, well, that's good because your costs have now dropped. What is bad, and what's going to be interesting as we enter into this next phase, is inflation, because inflation raises cost, and ultimately inflation reverses the direction of interest rates, because the Fed, as they just did, will use interest rates to choke off inflation. So if the Fed gets it wrong, Then you go into an expansionary cycle with inflation, you can get crushed because you're exposed for 6 years with this debt. So it can be your best friend. It can also be ultimately your enemy. Real quick, the other factors you got to take into account besides the markets, assuming the market's great, is your construction costs. And construction costs have slowed down, but they're still very high. Cost in construction with labor, materials, they never go down. So you're managing a lot of variables here, and interest is one of the most important. So ultimately, I believe it's a good thing for the next, hopefully, 12 months. But we'll see how much the Fed eases further.
I mean, it's great to sit up here with an economist who can really get into all of that. I mean, we're living a project right now with some great partners that we did. We actually took a flag off of a property and took it independent. It's adjacent to an amazing art museum in this very, very tertiary, to be kind, market, but it's an interesting place. And got stuck right in the middle of everything you just talked about.
Yeah.
And so construction, we opened it in last year, June, we opened, but the previous 2 years financed and developed it. And so the underwriting that we had is now very different. And it just is going to take a little more patience, and we're investors in this project also. So it is a different path. The stabilization process is just different than we anticipated. And it's hard. It's not huge numbers in the way that you guys are, but it's
all
meaningful
real,
to our
though.
partners. And so it just takes a lot of accountability, a lot of hard work to kind of get through this phase. But I think there's some light at the end of the tunnel.
Yeah. It's funny because, Jay, you mentioned the 6 years, that it takes. And so let's just say everybody believes now interest rates are going to drop right now. So now's the time to go get started. Okay, so if you start today, you will probably open the property maybe in 6 years, probably more like 8, which means that you're going to open just in time for the next cycle to end or start. And so
That's a realist right there.
yeah, but the point is like you almost have to ignore all of it. Focus on the location and your business plan and having the confidence that it's going to work no matter what. And because, Las Vegas just yesterday, they're still trying to get the ballpark built here for the Oakland A's to come here, okay? The A's are out. They're going up to Sacramento to play a minor league team, and supposedly they're going to be here in 2028. Well, today they have a city council meeting to hear that the cost went from $1.25 billion to $1.5 billion. Jeez. Now, I look at that and I go, it's only 250 million, And by the way, only about 300 million of that's actually got financing. And so, but the news is broadcasting this like, man, it's no big deal. I feel sorry for the guy who's got to sit there and talk to the city council today and explain to them where this other $1 billion is actually going to come from. But the reality is that it will get done, and they will find the money for a project like that because there is enough belief in it. But it's the same thing with any hotel project, and I do not know a project I've ever done that you started 8 years ago and it cost what you said it would then. And I can also be willing to bet that the numbers you did on the projections are also entirely wrong. Actually, what I've seen over time, the numbers, while the construction costs go up, the actual revenues and profit also increases. And I've been accused so many times of being overly aggressive in writing pro formas. And my first question to them is, okay, it's 11 o'clock in the morning. What's going to happen at 3 o'clock this afternoon? Do you know for sure what's going to happen at 3 o'clock? No. How are you going to tell me you know what's going to happen in 5 years from now if you can't tell me what's going to happen in 4 hours? Nobody knows. You have to actually believe in the project that you're putting together, the location, the business plan, and honestly, you got to have a lot of luck as well. And it's the timing of it. You can't control it. You do not know. Who would have thought in 2019, when the economy was slowing down a little bit, that in March of 2020, the global economy would just shut down.
Yeah.
like never in our lifetime would we have ever expected that to happen. And certainly from that point forward to today, every day is a whole new ballgame, and you know, we're still have the tsunami effect of that, although we don't talk about it anymore. But the reality is the world changed, and so now we're on that upswing, even with interest rates being higher. And I would argue that when the interest rates go up, and the competition will drop. So if you want to do a project, that's the time to get it done, because the second the interest rates start dropping, everybody and their brother is going to be going after that same deal, whether it's capital, debt, land, existing buildings. You're going to have a lot more competition. And if you time it right and you buy it at the top and interest rates are 8 or 9%, and 2 years from now they're back to 5, you refinance and you're 3 years ahead of everybody else who's trying to get in the game at the 5.
Very true.
Wow.
5 years from now, it's going to be back to 8, and they're going to be in trouble. So.
Mike, I want to bring you to those meetings with my owners and asset managers.
I want him to be
I'm
my
just going to bring you
financial
along here
partner.
to say what you just said.
It's amazing. It is.
No,
It's,
No, but he's right. If you're a contrarian in this business, that's where you make money.
Yeah.
When things are the worst, if you can get your deals financed because there's no competition, and then you're going to come into the market when things have radically improved, that is the right approach. But I do want you as my financial partner when $250,000's not much. I mean,
Yeah, I know.
$250 million's not much.
$250 million. Yeah.
Yeah, I used to sit on the receiving end of the revenue management at the hotels.
Yeah.
Where they'll say, how come the projections are not able to deliver what you said 6 years ago? So I can resonate
Oh,
what you
it's
said.
just hilarious. I literally, when somebody asks me that question, I look at them like, you know, I'm not the great Karnak. You know what I mean? Like, how am I supposed to know what's going to be happening in 5 years from now? I do know you got a good plan.
We are almost at time. Before we wrap up, any question for the panel? There you go. Go ahead.
You've talked about a lot of things, and I'm trying to be very apolitical in asking your opinion, you know, because we kind of feel the interest rates, you know, the cost of construction, you know, there's different, concrete's one thing, wood's another, but there seems to be a brand new mood in the political world today, based upon this most recent election, together with a lot of the swing in philosophies from the last administration, and I would refer to what was known as, or is known as, the woke world. You know, do you take into consideration when you evaluate this? Do you take into consideration the attitude? I mean, I don't know if you can moderate it, but can you take into consideration that there's a new mood here, that there's a new feel, a new esprit de corps as a result of maybe that we've tried another direction, so now there's a new direction in place?
I think that's an interesting question. Did everybody hear that?
Yeah, that's a great question.
Not sure
Go
who
ahead.
can answer it, though.
Well, I would probably pause. We are almost cutting into time, but you can grab them and get those answers during the break. Unfortunately, we are, you know, it's a
Oh,
very
it's such a
interesting
great
Let's talk about it.
question.
Yeah, it's a great question.
You're
but,
dodging the question.
no, I am not. No, I'm just getting
Is
signal
that the
that, yeah.
Department of Government Efficiency dodge?
Exactly.
Yeah.
Yes. But thank you very much, Mike, Sarah, and
Wow.
Joe, for very much great
Oh,
insight.
thank you.
Yeah.